Time for Hot Picks. Our guest says we can expect natural gas to play an increasing role in delivering low-cost, lower-carbon energy to customers in the US and across the world. Let's find out what three of his plays are in the sector. We're joined by Rob Thummel, Senior Portfolio Manager and Managing Director of Tortoise Capital. Thank you very much indeed for joining us. Can we jump right in? Your first idea is Williams Company, the pipeline giant, 4% dividend yield. Why do you like this name, broadly speaking?
Yeah, so if you think about Williams, it's one of the largest natural gas infrastructure players in the U.S. And if you think about the natural gas and the location of where Williams' pipelines are located, they're located in some ideal situations. And the economic moat of Williams is tremendous. So what I mean by that is it's impossible to really replicate the network of natural gas pipeline infrastructure that Williams operates. And so if you believe in natural gas, and at Tortoise, we believe that the energy sector is going to really be redefined over the next several years, and natural gas is going to be the clear leader. You're going to see a lot more demand for natural gas that's driven by a couple things: more exports of liquefied natural gas out of the U.S., as well as Canada as well, but then also more demand domestically as electricity generation increases, and natural gas is that primary fuel source for demand. So Williams is going to be actively involved, and that's going to lead to growth. So that dividend of 4% is going to grow 4 or 5 or 6% a year for an extended period of time. All that said, when you look at the valuation of Williams right now, it still trades at a discount to where we think it should trade from an enterprise value to EBITDA perspective. So we think that the Williams stock is great for really uncertain times because it offers a certain dividend, and there's certainty in the dividend. It's got growth, and it's still trading at a discount to where it's traded at historically.
Your next idea, it's another energy infrastructure company, Energy Transfer, ET. Just remind us what they do and why you think they offer promise.
Yeah, so Energy Transfer, another large energy infrastructure company. And it's a little more expansive in terms of the products that it transports. So Energy Transfer owns the pipelines that transport lots of different energy commodities, whether it's natural gas is one component, oil is another component, and then also what are called natural gas liquids, not to be confused with LNG. These are NGL. So natural gas liquids are things like ethane and propane. And so Energy Transfer has just got this broader diversified approach to the way they run their business. Now, look, if you like dividend yields, Energy Transfer is really attractive. It's probably a 7.5% dividend yield. It's going to grow the dividend 3 to 5%. So when you look at, if you're looking for really high quality dividends, Energy Transfer is a way to play that. It's a investment grade rated company from a debt perspective. So we really like Energy Transfer for its dividend and its growth, and really the fact that it's going to have growth potential from multiple commodities across the U.S.
And finally, Cheniere Energy, a huge player in LNG exports.
Yeah, so I mentioned exports. So liquefied natural gas exports, and that story has been one that's really tremendous in the U.S. The U.S. has gone from a net importer not that long ago of natural gas to the largest liquefied natural gas exporter in the world. This whole industry's been created, this LNG, liquefied natural gas industry, just really over the last decade, and even probably maybe over the last 8 years. Cheniere Energy is the largest energy exporter of liquefied natural gas in the U.S. The company has a tremendous management team. They've been very capital disciplined. They've been really good at allocating capital. They've really converted from a construction company to now to an operating company. They've got a small little dividend, but they're going to grow the dividend. But more importantly, they've been buying back stock, which is an indication to us that they think the stock is cheap. Mm-hmm. We agree with that. We think that the stock's worth a lot more value. The reason why is because the Energy Transfer has multiple years, maybe multiple decades of free cash flow that is consistent, steady, it's recurring, it's a kind of annual recurring type of free cash flow that we just don't think that the market's valuing appropriately. And so for all of those reasons, we really like Cheniere Energy as well.
That's interesting. Yeah, this global shift towards LNG. Apparently in China, the energy giants are doing that because the EVs are eating into gasoline demand. That was great. Thank you very much indeed for joining us.
Thanks for having me.
Rob Thummel, Senior